Hey guys, Joe here. Welcome back. We're here with another episode of Ask a Loan Officer with my friend.
Richard Medina with Essex Mortgage.
All right, how have you been? It's been a while,
I've
right?
been good. It's been about a month. I know we said we are going to try to do this monthly, and
But live.
yeah, but at least we made it at the end of the month. So
I know. I feel we both have grown since the last time we saw each other.
yeah.
So you want to start us off with what the interest rates are and all that?
Right. So the last time that we met, I believe it was back in July,
Mm-hmm.
and the national average interest rate was about 5.7%.
Mm-hmm.
Today is September
Eighth.
8th,
Yeah.
2022. And as of today, the national average rate is about 5.89.
Okay.
So as you can see, it's gone up.
Yeah.
Like I said last time, people are always asking, when's the best time to purchase? When's the best time to buy? It's now,
Mm-hmm.
because you're not going to see these rates go down. They're just going to keep going
Yeah.
up. So you want to grab a rate now, so this way you're not too late on these rates, because they're just going to keep gradually going up.
Mm-hmm. True.
Best time to buy is now. So
That's
reach
what
out to
I
us.
said. Yes, exactly. I think I posted something today saying that people complain about the interest rates, but if you're renting, like that's 100% interest right there that you're
Correct.
paying. You're not getting anything in return.
Correct. You're already paying
So
100% interest with rent right there.
yeah, you're just
So
making your landlord rich.
might as well gain some equity in your property and be an owner.
Exactly.
So
Okay.
earlier we were talking about the national average interest rate being at 5.7% back in July.
Mm-hmm.
Right now we're at 5.89%.
Okay.
That's with buy down points.
Mm-hmm.
One of the questions that you guys had, I
Yeah.
believe, were what were buy down
Yeah.
points.
People were asking what was that.
Okay. So buy down points. The way that that works is roughly a buy down point is 1% of the loan amount. So for example, let's say you have a loan amount of $200,000. A buy down point would be $2,000. So when you have a mortgage, you get the option to purchase buy down points, and you can purchase buy down points for a lower interest rate. So it really just makes it depends on each person's situation, really, how long
Mm-hmm.
you're going to be staying in that home, the type of
Okay.
loan program that you're going with.
Yeah.
And really what we want to do is we want to determine your break even point,
Mm-hmm.
and we'll do that for you. So you come to us, we'll figure all this out for you, and
Yeah.
we'll let you know whether it makes more sense to go with the purchasing these buy down points or to go with the rate that was actually just given at the time. So
Okay.
we're here for you, and we'll help you out.
Yeah. Another question that people were asking is regarding applying for a loan. Is there a limit of how many people could apply together? And if so, what's the benefit or the downside to that?
Okay, so technically, for a conventional loan, no, there's not a limit, not a
Hmm.
legal limit. However, I know for our automated underwriting system, that you can only put in 4 borrowers. So it'd
Oh,
be a
okay.
total of 4, and
Uh-huh.
then everybody after that you'd have to add in, I guess, manually.
Oh, okay.
So it would be lender by lender would be able to kind of
Hmm.
determine whether you can go more than 4 for a conventional. Okay,
Yeah.
and for the FHA,
Hmm.
it would be 3. So it'd be
Okay.
3 borrowers that you can have. The upsides and the downsides to having multiple borrowers versus, let's say, just one borrower.
Hmm.
Um, let's say, for example, you make a certain amount of income,
Yeah.
but you need more purchase power.
Hmm.
You need more income to be able to get the loan,
Yeah.
to be able to purchase the home that you want. So
Okay.
to be able to get more purchase power, you add another borrower onto your loan, and
Gotcha.
then you can possibly qualify for that loan.
Okay.
A downside to that could be, let's say, if they have a lot of debts, that can also hurt you.
Okay.
Or let's say if they have a lower credit score than you, then
Hmm.
they're going to end up going with their credit score. So
Oh.
that can hurt you as well. So there's upsides and downsides to it. We play out each scenario and we try
Yeah.
to see what would work best. So we will let you know, whether it works best with you, whether
Uh-huh.
you should add on a significant other, a
Hmm.
brother, a sister, a
Hmm.
family member, or so on.
Okay, so they always go with the lowest score then?
So typically the way that it works is, let's say out of all of you guys,
Hmm.
they would choose the lowest score, the person with the lowest score,
Hmm.
and then out of the 3 main credit unions, they would choose that middle score.
Oh, okay, gotcha. Alright. I know we've been talking about this a lot, and maybe not all people know what this means, but what exactly is loan to value?
Okay, so the loan to value, it's expressed in a percentage, and basically what it is it's your debt, and the way it is your debt relative to the value of your home.
Okay.
And then the way that you would get that is we would figure that out for you once again. These are all terms that we don't expect you to become
Hmm.
professionals on. That's why we're here for you, to be able to help
Exactly.
you out. But we do kind of want to hold your hand and lead you and give you some information.
Hmm.
But basically, it's a criteria where that kind of figures out the maximum lending that they can give you, and
Okay.
it's a number that you cannot exceed.
Uh-huh.
Um, that we're trying not to exceed when we're putting together your actual paperwork. So
Okay.
yeah, but you reach out to us, and we'll definitely be able to help you out and get you some more information on that.
Okay. And what about debt to income? Can you explain a little bit
Your
more in detail about that?
your debt to income ratio. So once again, that's another number that you cannot exceed for certain things like a conventional loan, a
Hmm.
FHA loan.
Hmm.
And really, it's the exact way that it sounds. It's all of your debts that you have throughout the month
Hmm.
versus your income, your gross monthly income that you take in.
Okay. And what do you
Um,
think is like a good number to be in?
so typically for conventional and FHA, there are different numbers.
Hmm.
So it just depends on the type of loan that you're trying to qualify for.
Okay. All right, guys. Well, thank you for watching. This is all the time we have today with Richard. Thank you for answering all our
Thank you
questions.
guys.
I know buying a home can be very scary, but we're here to guide you every step of the way.
We're
So,
here for you. So the more questions that you can submit, that's more that I can answer. So I'd love to help you guys out. So keep them
great.
coming.
All right, sounds good. Thank you, guys.
Thank you guys. Take care.
Bye.